Jabil Inc., one of the world's largest manufacturing and supply chain solution providers, has once again made headlines after reporting strong fourth-quarter fiscal 2025 results. With both revenue and earnings exceeding Wall Street expectations, the company continues to attract investor attention at a time when global supply chain dynamics, artificial intelligence (AI), healthcare, and cloud computing are reshaping industries. But with Jabil's stock having already rallied significantly over the past year, the central question for investors is, does JBL stock still present an attractive opportunity, or is much of the good news already priced in? This article provides a deep dive into Jabil's latest earnings, key growth drivers, challenges, valuation, and long-term outlook, helping you make an informed decision about whether to invest in JBL stock. Section 1. A snapshot of Q4 2025 results. Jabil reported a strong set of results for Q4 FY 2025, highlighting its resilience and execution in a challenging macro environment. Revenue: $8.3 billion, up from $6.96 billion last year and well ahead of the consensus estimate of $7.66 billion. GAAP net income: $218 million, or $1.99 per share, compared with $138 million, $1.18 per share, in the prior year. Non-GAAP net income: $360 million, or $3.29 per share, versus $270 million, $2.30 per share, a year ago. Consensus beat: earnings per share comfortably beat Wall Street expectations of $2.95. The revenue growth was broad-based, with healthcare, retail automation, capital equipment, and data center infrastructure being key contributors. The intelligent infrastructure segment was particularly strong, benefiting from demand in cloud and AI-driven data centers. This robust performance underscores the effectiveness of Jabil's strategy: diversified end markets, strong execution, and focus on innovation. Section 2. Jabil's diversification strategy, a moat for the future. One of the most impressive aspects of Jabil's business model is its deliberate diversification. Management has set a rule that no single product or product family should account for more than 5% of annual operating income or cash flows. Why this matters? It minimizes dependency on any single customer or market. It reduces earnings volatility during downturns in specific industries. It ensures Jabil can consistently generate long-term returns across cycles. Currently, Jabil operates across 100 locations in 30 countries, serving industries such as healthcare and life sciences, benefiting from demand for medical devices, diagnostics, and drug delivery systems; cloud and data center infrastructure, boosted by AI adoption, 5G rollout, and hyperscale cloud spending; retail automation and industrial, supporting next-gen retail systems, robotics, and industrial automation; automotive and EVs, addressing software-defined vehicles, hybrid and electric platforms. This diversification is a core reason investors see Jabil as more than just another contract manufacturer. It positions the company as a strategic partner in the AI, healthcare, cloud, and mobility revolutions. Section 4. Riding the AI and data center wave. AI is arguably the single biggest driver of technology spending today, and Jabil is squarely positioned to benefit. The company's 800G silicon-photonics-based optical transceiver modules, developed in collaboration with Intel, are specifically designed to power the next wave of AI/ML workloads. Key points: silicon photonics advantage. Intel's proven platform allows for wafer-scale integration of lasers, improving reliability and cost efficiency. Jabil's role: manufacturing expertise ensures scalable, reliable production at global volumes. End markets: data centers, cloud computing, and AI infrastructure are seeing exponential growth in demand for faster, more efficient interconnects. With hyperscalers and AI players requiring massive bandwidth for model training and inference, Jabil's optical modules represent a crucial enabler for the AI ecosystem. The competitive landscape. While Jabil's growth story is compelling, the company operates in a highly competitive industry. Its key rivals include Flex Ltd.,
FLEX, another diversified contract manufacturer with strong exposure to industrial and automotive. Celestica Inc., CLS, has outperformed dramatically in the past year, up 366% compared to Jabil's 77%. Foxconn and other Asian manufacturers, low-cost, high-volume competitors in consumer electronics. Competition in electronic manufacturing services, EMS, is fierce, often leading to margin pressures. Jabil's edge lies in moving beyond commoditized segments into higher value verticals such as healthcare, photonics, and industrial automation.
Expansion in new growth markets. Beyond AI, Jabil is also making bold moves in new geographies and verticals. India expansion. New operations in Gujarat to support photonics capabilities. Taps into one of the fastest-growing markets for infrastructure and domestic consumption. Pharmaceutical solutions. Acquisition of Pharmaceutics International Inc. provides access to a $20 billion market and expands Jabil's role in drug formulation and delivery solutions. EV and energy infrastructure. Supporting software-defined EV platforms. Leveraging opportunities in power and energy infrastructure crucial for electrification trends. These strategic expansions diversify revenue streams even further while positioning Jabil for secular growth drivers in healthcare, EVs, and clean energy.
Section 6. Macro risks and headwinds. Despite its strengths, Jabil faces several external challenges. Geopolitical tensions, U.S.-China trade disputes and technology restrictions, wars in Europe and the Middle East disrupting global supply chains, consumer electronics slowdown, weak demand in connected living and communications, volatile EV demand due to tariff changes and shifting incentives, cost pressures, rising raw material and R&D costs, tariffs and inflation driving up input prices. These risks explain why Jabil, despite strong earnings, continues to trade with some cautionary sentiment. Section 7. Stock price performance. Over the past year, Jabil stock has delivered a 77% gain, a strong performance but still lagging Celestica's explosive 366% rally. Jabil, JBL, plus 77.3%. Flex Limited, FLX, plus 73.5%. Celestica Inc., CLS, plus 366.1%. Industry average, plus 124.8%. Jabil's gains reflect its solid fundamentals, but investors must ask whether it has more room to run compared to peers that have already priced in aggressive growth. Section 8. Valuation check. Valuation is one of the most important factors in the JBL investment debate. Fair value estimate, $230.25 versus current $215 stock price, suggests JBL is approximately 6.3% undervalued. PE ratio, 35.2x, higher than industry average of 24.4x and above peers at 33.3x. Forward estimates. FY 2026 EPS forecast, $11.05, up from $10.97. FY 2027 EPS forecast, $13.08, up 1.7% in the past week. Interpretation. Fair value models suggest moderate upside, but the elevated PE multiple introduces valuation risk. Investors are paying a premium for Jabil's diversified growth and exposure to AI. Section 9. Analyst sentiment and estimate revisions. One bullish sign is that analysts are raising estimates. FY 2026 EPS revised upward to $11.05. FY 2027 EPS revised upward to $13.08. Estimate revisions are often a leading indicator of stock performance, as they reflect improving confidence from Wall Street in Jabil's execution and growth trajectory. Section 10. Long-term investment thesis. Jabil's long-term prospects remain compelling, anchored in secular growth drivers and its diversified model. Bull case. Strong growth in AI, data centers, and cloud computing. Expanding healthcare and pharmaceutical presence. EV and renewable energy tailwinds. Diversified model reduces risk of over-reliance. Robust free cash flow supports dividends and buybacks. Bear case. Competitive industry limits pricing power. Cyclical demand in electronics and EVs. Geopolitical and macro risks could disrupt supply chains. Elevated PE ratio means limited margin for error. Section 11. Key investor takeaways. Strong Q4 performance. Revenue and EPS beat expectations with broad-based growth across segments. AI leadership. Jabil's optical transceivers position it at the heart of the AI infrastructure buildout. Diversification advantage. No single product family drives more than 5% of income, ensuring resiliency. Valuation risks. PE ratio suggests investors are already pricing in growth, leaving less room for error. Cautious buy. With a fair value of $230.25, JBL appears modestly undervalued, but competition and macro risks warrant caution. Conclusion. Should you invest in JBL now? Jabil has delivered another impressive quarter, showcasing why it's more than just a contract manufacturer. Its presence in AI infrastructure, healthcare, EVs, and industrial automation makes it a key enabler of multiple megatrends. At the same time, challenges remain. The competitive environment, global uncertainties, and cyclical demand patterns could weigh on future results. Valuation is not cheap, with JBL trading at a premium multiple relative to peers. Final verdict, Jabil is a long-term growth story worth watching, especially for investors bullish on AI and diversified manufacturing. But for new investors, it may be prudent to enter on dips rather than chasing current highs.